Somebody told me once too, if you do 5 deals, there's going to be one home run. There's going to be three right down the middle of the fairway, and probably one of them that's lagging or not where you wanted it to be. And it's true in multifamily too. Not everybody can hit a home run all the time. If you're in the business long enough, you're going to have a fire or some kind of violence on the property, and bad things happen. It's how you manage out of them and how you operate out of them.
In this episode, I talk with Randy Langenderfer. Randy is a former chief compliance and audit officer and now full-time real estate investor. He started off with a duplex and has since invested in over 4,000 units. We discuss how he was able to invest in so many units with a full-time job, his first real estate investment, house hacking a duplex, private money lending, and multifamily investing. I hope you enjoy. Now on to the show. How you doing, Randy?
I'm doing good, Chris. Thanks for the invite.
Thanks for having, or thanks for coming on. So just kind of jumping right in, you've invested in quite a number of units, upwards to or over 4,000, right? Does that sound right?
Yeah, that last count, it was around there.
Okay. So has that primarily been on the GP side or LP side or both, or how'd you get that number?
So I'll give since we have a little bit of time, I'll give the long answer. So my journey started about 10 years ago when I really was trying to develop a passive income stream. I've been in corporate America for a long time. I just recently stepped aside to do full-time real estate. But prior to that, I started out looking for another income stream. I was working for a private equity firm. I was doing pretty well, but I just realized that wasn't going to last forever. And so I started out doing single family flips. I was a hard money lender with my brother-in-law, came to Houston for business, learned multifamily, didn't want to do active investing to start with. So I started passively investing, and I tried to connect with general partners that were willing to spend some time with me and kind of teach me the ropes along the way. And so, yeah, I invested in many as a limited partner until 2018, did my first GP. Fast forward to today, I'm about 1,100 doors in as a general partner, and I don't know, several thousand. I really stopped counting, quite honestly, because I just like the asset class.
Yeah.
And I'll always invest in both as long as I have money and can invest in other people's deals that I like. So dual stream, it's just helps your returns.
Yeah, I love it. But so that's multifamily. You actually didn't get started with multifamily, from what I understand. Your very first investment property was actually your very first primary residence, right? You went the house hacking route, which is a bit unusual. Tell me about that.
Long time ago. Yes. So always had an inkling for real estate. As a young man getting started, I didn't have two nickels to rub together. And my wife and I conned my wife, I should say, conned her. I convinced her how we could financially gain by. So we bought a duplex, is a short answer. We bought a duplex, and we lived in half and rented out half, the other side of it, to a variety of people. And, that's when I realized that I did not want to do property management.
Especially when you're that close to the tenant.
And
there's no hiding.
There's no hiding. They lived right above us, and so, but we grew out of that as our family grew. We had our first child. We stayed there for about another year, and that was challenges of trying to keep the little one quiet for the tenant upstairs, because it was an old house and there wasn't an ounce of insulation in it anywhere. And then second child was born, and we just grew out of it quickly. So, but I maintained it after we had the second child. We bought a house and I maintained it, and house hacking got my fever answered a little bit in the real estate side, and then got busy with life and raising a family and, climbing the corporate ladder, as they say, and came back to it later in life.
Nice. Yeah, I did a little different. My first primary resident, which I bought single families as investment properties prior to that, but my first primary resident, I just got roommates. It was still single, got roommates, and I forget the economics. I think we just did it a third. I think it was very fairly even, but it was a good deal.
You were ahead of your time. You were renting rooms before it was popular or a thing then.
Yeah. And they took care of all the lawn. We split the utilities. It was a good gig while it lasted, but then people started they started getting married off, and eventually I did too. So, um,
It's all good.
what made you decide to get into hard or private money lending?
So I said I was looking at another income stream, and I had, like many people, I had no idea what that meant or how it looked like. And I had a brother-in-law who was an exec for a big regional bank. We were living in Cleveland, Ohio at the time, and his brother-in-law was a big exec who had just gotten displaced, and he got the wild idea to go to Armando Montaleglo's house flipping school in California. Spent, I think it was a week or 2 weeks out there, paid big money for the course, came back to Ohio and invited me to join him. And I said, "You're crazy."
Now, was
And
that course was on like flipping or wholesaling, or was it on?
flipping,
Okay.
flipping. I don't know if you know Armando Montalego is one of these late night infomercial guys
Yeah,
that,
yeah,
that
yeah.
does house flipping, and he sells a whole course. And so we got connected with a group out of South Florida where they identified the property, they put together a budget, we uh, reviewed it, analyzed it, looked at the comps, and committed or not committed, and then we would lend them the money to buy the house and make the renovations, and we would just take a percentage profit on the back end, X amount of percentage points. And that was good for several years and satisfied my real estate itch. But when I moved to Houston, it just became a new city, and I became overwhelmed with how big Houston is and the different submarkets, and trying to get acquainted with different submarkets and different groups, and how conservative people were stylistically or not. And it just became very time consuming to get any momentum at all. And about the same time, I attended one of the big conferences here in Houston called Lifestyles,
Yep.
where they preach single family and multifamily, and they do a weekend course. And I went to it, and they teach single family on Saturdays and multifamily on Sundays. And after I sat through that weekend course, Chris, it was kind of a no-brainer for me to start doing multifamily. Economies of scale and non-recourse lending and the concept of syndication. And um, so it was then that I just kind of never looked back and started going after it.
Yeah, I know a lot of the OGs, and I say OGs of like my generation, that kind of came through the real estate investing grinder post 2008. Um, a lot of them really credit the lifestyles education, at least that weekend boot camp. Not necessarily. I mean, some went into like their mastermind and went through all that, and I've heard good things about it too. But just that weekend boot camp of
Yeah.
the educational impact versus the cost. I don't know what it costs now. I think it was like $500 back in the day, maybe $300. Um, was very profound, and a lot of them went to do some really good things. I don't know why. I never did that. I've gone to their annual stuff, and I always go to their annual stuff because I love Dell's market updates. But
They're expos here in Houston. Yeah.
yeah. I think they do one in Houston and one at another location. But yeah, that's pretty interesting. So now you're saying that, hey, you're doing some hard money, but you're not necessarily wanting to scale that, and this is
Yeah.
when you discover multifamily.
That's exactly. So we'd had some success with hard money, and I am pretty handy with a hammer and pliers and a screwdriver and all that stuff, but I just never wanted to spend I had done that on the house hack, my nights, weekends, et cetera, being the maintenance guy as well as the landlord, and et cetera, et cetera. And I just did not want to do that. So that's what drew me away from, I should say, the house hack and the single families. Is, I was talking to an investor yesterday who's got 8 single family homes, and he owns a large percentage of those homes, and he's got a good cash flow. And I said, comparatively, you own a lot in a few. I own a little in a lot of doors. So they're both fine.
Yeah.
Both strategies work. It's just, what do you want to do? And maybe I'm just lazy. I didn't want to work that hard.
Well, maybe looking back, do you think it was necessary for you to start out with single family in any capacity before moving into multifamily, or is it with the right education, of course,
Yeah.
is it perfectly fine going straight into multifamily if that's what you want to do?
Yeah, and I think I was very typical at the time. I think most people start out not having the concept of multifamily or even big multifamily and thinking that's way above them and that's out of their reach.
So real estate investing in your mind at the time was single family house, you flip or you've got it as a rental. Like
Buy and
that's your
hold or flip.
concept. Yeah.
Yeah, buy and hold or flip. And that's my paradigm, for lack of a better word. And I think I'm a lot of people like that, maybe even those that are educated, until and then you just realize it's so much work. And there's much less work and economies of scale to scale a single family business to 100 units is a lot of
Yeah.
work. You got to develop all the back end maintenance, leasing, etc., proficiencies and landlord. I mean, there are the laws of the state of which you operate in. And so it's just very uh, overhead intensive. And
And
converse,
you don't really get a lot of immediate reward for that. Like
yeah,
it's and it is a very good investment strategy because of wealth building and then also wealth preservation through tax. But as far as cash flow, yeah, you really need to own 50 to 100 plus, and then also have a rock solid management team to keep you out of the
courthouse.
migraine mode.
And as a business guy, as a corporate guy, trying to do risk mitigation stuff, of which I specialized a lot in my corporate life, it just becomes a no-brainer personally, because you get economies of scale in multifamily. You get the concept of non-recourse loans. So every one of those single family homes is a recourse loan to the buyer or to the landlord, meaning, the bank can come after you if
Yep.
you were to
Yep.
default. In a multifamily, the non-recourse loans, you can lose your investment, but the bank can't come after you for your personal assets. That was huge to me, having been in the corporate world and having not rich, but had a few assets that I really didn't want to gamble on losing. So it's economies of scale, non-recourse debt, and then most importantly, being able to hire a property management company.
Yeah.
So we become, as you know, the asset managers, where you're overseeing the property manager who does the day-to-day leasing activities, maintenance activities, and deals with all the tenant issues. And thank goodness they do what they do. Because as I started out with, I didn't want to do that. So those are the three big drivers and then you look at, the tax advantage, the cash flow advantage, and the appreciation advantage. And um, it suits my personality. It may not suit everybody's, but I think people should challenge themselves to get educated, because I think you mentioned that, and that's really the big thing, is to educate yourself and understand the differences and make your own investment strategy
Yeah,
with your
I
own.
mean, it really depends on what you want, what your education basis is. I mean, you shouldn't invest in anything that you're not educated about. Um, and you could do both. But my realization on that came from buying these rentals, and we're doing a lot of flips too, but buying these rentals and realizing like, hey, from a wealth building standpoint, like these things are great. Like I did not flip. I wish I held more and flipped less. So from that aspect, they were great. But from a management, operations, and even the asset management, um, it it was a challenge, and cash
Yeah,
flow was like by the time you factor in vacancy, repairs, capex, and all this stuff, it's not really there. And then it really hit me when I joined EXP and like revenue share, and then it's not real estate income. It's through my brokerage, completely different. But within like
yeah,
18 months, like I had tripled my what my rental income just from rev share, and then our first large multifamily, and then I was like, okay, I get it now. I get it now. The economies of scale now, it basically gives you the ability to afford a higher caliber team, really in
yeah.
all aspects, not just property management, team to oversee an asset and its performance far better than what you could personally.
Yeah, and I really think, looking backwards, it's probably a disadvantage of my education. Um, because if I had been more of an entrepreneurial mindset, I would have recognized it much earlier. But I guess my education and taught me be risk adverse and to et cetera, et cetera. And I'm an MBA and a CPA, so my weakness is over analyzing things.
Yeah, well,
Uh,
maybe go into that a little bit. So your education and background, you got a lot of background in finance and accounting and both education and your corporate background. So how did that play into, or expand a little bit how that played into your investing career?
yeah. So as I mentioned, I'm an undergraduate accounting information systems, MBA in finance, CPA, et cetera, et cetera. And that means nothing for real estate other than I took a bunch of tests in life. But having worked in the corporate world for a long time and been a finance person at heart, finance people, I always say, are risk adverse to begin with. They say no 4 out of 5 times, um, as compared to the marketing mindset that says yes 6 out of 5 times. Uh, and I'm not picking on my marketing friends, but I am a little bit. So I'm risk adverse to begin with, and I'm analytical in nature. So my wife gives me a hard time. She goes, just go spend some time in your spreadsheets and enjoy yourself. Uh, and there's some truth to that I am the analytical type that likes to understand that. But I think that's truly a detriment. And starting out, because, I always say you may have heard the illustration of ready, aim, fire. So I'm ready, aim, 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 and then fire until I got through it once or twice. And I think I'm much more comfortable with the risk profile now and the variables that I need to understand to make an investment decision. But you get your engineers, your IT technical types, your finance accounting types, and I'm not disrespecting any of them, but they all tend to be very analytical in nature, and that's what their education has taught them. And so they want to fully understand every risk before they invest in it. But I think it's back to the 90-20 rule or 80-20 rule, whatever you want to call it, that if you understand 80% of it, you're probably good enough to go. Just don't spend your last $50,000 on an investment. Make sure it's disposable income.
I think
But
that's where teams come into play. So standalone, someone who's heavy analytical like you are, and so they tend to move slower, maybe risk or miss opportunities, which that has opportunity risk, right? Opportunity cost risk, versus someone who's on the complete opposite spectrum, who's go, 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 makes a huge mess, maybe wins at the end, probably got a lot of bumps and bruises on the end. But when you combine those two into a team like that
yes,
balance each other out, that's where a rock solid like CFO and an operator, especially if you have an operator, CFO, and a visionary, all three combined, like that's what you see in some of the most successful businesses and teams, and how you have companies grow from 0 to 500 in a couple of years.
well, you hit it on the head. You hit it on the head, and I think as there's your audiences out there listening, when I talk to people about building teams, you don't want to find people that are just like you. So I don't want to attract other analyticals, although that's probably the place where it starts, and I can build a conversation and with other analyticals easier than I can a marketing type. But some of my best partners, as you said, have been the marketing types, where they're the visionaries and I'm the analytical type. And if you throw in a third person with an operating history there, I think you hit it on the head. You're dynamite. And those are what your audiences should be looking for, somebody to complement your own skills wherever you
Yeah.
are.
And I'm a weird breed because I'm both. I'm definitely very much a visionary. I can operate, but I'm also analytical. And it's weird. I've got this, and I pulled myself all the time. I can get bogged down in details, but then in complete other situations, I don't care about the details. Give me the bulletproofs, the bullet points. Give me the highlights. Like once you start going into details, like I'm tuned out. Like, but I'll nerd out on weird things. Like something will come on TikTok or whatever, and they're like, boom. The next thing I'm learning about is, I don't know, black holes and quantum physics and whatnot, and I'll spend like the next 45 minutes learning about things I can't even pronounce. So I don't know. It's weird. I don't know.
But I
I'm a
think
weird breed.
No, you're not weird. You're called a generalist. And I don't know if you've ever taken any personality tests, Myers-Briggs or others.
Yep.
You should, people should do that for themselves. They can do them online easy today. But I was just going to say I think in my own area, I'm very analytical and very detailed on the first investment when I go with a new group or a new market, but I also conversely have on the limited partnership. I don't do this with other people's money, but in my own money, if a guy that I've known and I've done 4 or 5 deals with calls me, I don't even look at it anymore. If I've got spendable cash, it just goes in there
Yeah.
because I know, like, and trust the group or the person. And, that's where I think everybody wants to get to, where you really trust them. And the guy, I'm thinking of two particular that haven't done me wrong in 10 years and returned very handsome returns to me.
Yeah.
And so I'm not nerding out on those at all. But conversely, I'm looking at a new group in Phoenix right now on a deal, and I'm turning over every rock that I can, including getting on a plane and going there and driving the comps and talking to the property management company and et cetera, et cetera.
Yep. Yep. So what are the top things that you look for in operators before investing with them?
Yeah, and I had this conversation with an investor I was talking to yesterday who's just getting started, and he asked me, what's the first thing you should be looking for? And you and I know that, it's the horse and the jockey illustration, and in a horse race, which is more important, the horse or the jockey? And in multifamily, it's who's more important, the operator or the asset, the market in which they're in. And the answer is always the same. It's the operator or the general partners. Who are they? Who are they? And do you know, like, and trust them? What's their success record or track record? I know very few people that don't have a blemish someplace along the way or a war story to tell. I know very few that come out with it right away and tell investors some of that history. So the first thing for me is the general partnership group. How do I know them? Where are they trained at? Do they come from Lifestyles or Jake and Gino or Mark Kenny or Brad Sumrock, any of the big groups? That's not bad, but I personally want to see that they have some multifamily training.
Mm-hmm.
And each of those groups has a different plus and minus. So it's the group, it's where they came from, because that tells you something about their underwriting style and the templates they use. And so I've had the advantage of seeing many of those different templates and how they work. So I have familiarity with them, comfort with them. And then I start digging into the underwriting assumptions. So what's the reversion cap rate? What's the growth, income and expense assumptions for growth? Reversion cap rate, I think one of the most often overlooked ones is understand the relationship between the general partner and the on-site property management company.
Mm-hmm.
Have they worked together before? Is this the first time they're in this market? Does the property management company have experience in the asset type you're looking for? I mean, perhaps they have a Class A focus and you're looking at a Class C property. And again, you need to understand the relationship between the general partners and this particular property management company, because they're the ones that are on site day to day, and they're the ones that are going to make this an average investment or a great investment.
100%. Yeah, they're the boots on the ground, and that's a really good observation too. Do you have what are the pros and cons when you see that it's a vertically integrated property management, meaning the operator, it's their company, versus using third party?
The operator in that vertical integration, right? They have their own property management company. They have their own construction company that are making unit turns and renovations. I really think that is a strategic advantage this day and age. In the last couple of years, as the markets become tighter, I think those companies that are vertically integrated have an advantage because they can control their cost. There's a disadvantage, though, that they're making money on multiple pieces of the business, on the asset, on the property management side, on the construction side, et cetera, et cetera. And so you have to be careful.
Do you ever have concern about transparency risk?
The ones I know of and have invested in, I'm not um, because they have disclosed it and they've talked about it in a very transparent manner. And
Hmm.
um, I think you just have to ask the question if you're an investor, how are you being compensated, Mr.
Yeah.
Partner, General
Yeah.
Partner,
Which if they're doing a
in this?
syndication or fund, that they have to disclose that anyway. But it doesn't mean that they will, or
They
that it's going to be that clear.
It may be buried right on page 55 in font 2. Uh,
Correct.
and that should be a red flag to a potential investor. But I think I really, at least, and I don't think that vertically integration works until you get around 1,000 doors in a
Yeah.
specific region. So other ones, as you see people trying to vertically integrate, and they're in 3 different states and different submarkets.
At that
I'm
point,
not
it
sure.
becomes an operational anchor.
Yeah,
Because
because
I mean,
they got overhead they got to cover,
yeah,
and they're sending people from Texas to Louisiana or Ohio or
and
wherever.
time. I mean, really, because all property management, it's a complicated business anyway. But it is a business, and a new business, a baby business. Yeah, a new business is like an infant. Uh, it requires a lot of attention, or like an infant, its health really deteriorates if you don't take good care of it.
Careful. That's a good illustration. I like that.
So yeah, that's a good observation on the property management in that relation to the GP, because you're right. If they do have concentration of units in a market, then it absolutely makes sense. They have to vertically integrate, otherwise they start losing efficiency. Um,
But I like the third party style. Maybe it's because I haven't gotten to that 1,000 doors in a specific submarket yet. But I think there's strong advantages to third party property management. One of the guys I invest with most has about 10,000 doors, and he does nothing but third party property management. And the argument there is you can leverage them to do things that operationally you don't have to do or want to do, and apply pressure to them to make changes quickly, and they become so dependent upon you anyhow, because in that situation they're huge. We bought, for instance, we bought last year a 60 unit brand Class A building here in Houston, and not many people want to manage a 60 unit, but we got affiliated with a large property management company. And in that case, it's been wonderful because on that side, it's the only one we have in this market right now. And in that example, it's been wonderful because they bring the leverage and they bring the economies of scale that I could never have as a sole operator of a property management firm in the Houston market. They have every contact imaginable, from, you know, tax consultants to window repairs and everything in between. And so there's a real advantage there. And I don't personally, going back to my first experience, I don't ever want that headache. Property management is a very ugly business,
yeah,
no matter
yeah.
who's doing
Going
it.
back to owning single families, like I had to do with a fence repair recently, and getting quotes. Now, thankfully, with fencing, I still have good contacts, but we've also had to deal with plumbing over the last few months too. And with pump, this is all these reasons are reasons why I'm slowly divesting of single family. But plumbers, I don't know what it is about plumbers. Like, it's my experience with plumbers. It's I've had a hard time keeping good plumbers in my Rolodex. So it's just a challenge. But with a rock solid property management company, like you don't have that. I mean, commercial's different.
Right.
So plumbers, electricians, all these trades, when they get in with these property management companies, they tend to stay. At least the good ones, because they know what that's
Yeah.
worth.
And they get the volume, as the plumber in your illustration gets the volume of work that they're looking for, and the continuity of ongoing work through the asset or through the property manager's many different properties for work. And nobody can afford to have a single plumber on staff at a multifamily just because there
Yeah.
isn't enough work. So that's the advantages of a third party. You're absolutely right.
Yeah. Now, I would say one other one too is insight. Like if you have 1,000 units and you're managing all of your 1,000 units, but that's your basically your exposure. Maybe you've got a couple third party clients versus someone else who they have 10,000 plus units. they're seeing and hearing things that you're not, and they're seeing and hearing it before you are. They can react faster if they're good. So there's a um, certain advantage that you could have working with third party.
We have another example for your listening audience is one that, is ever increasing in the multifamily world is social media presence and advertising online and getting the lead funnel or your property in. So these bigger firms have a social platform that helps you with all that versus as a sole proprietor trying to do property management, I'd have to do all that. And that's just not something I want to do, Chris. I don't know about you.
So what's your advice to people who are considering making their very first passive multifamily investment?
Well, I think it's the first one, and the one I'd say that I'm still doing. I know you are too, which is just education. The big one is for me is understanding as an investor, understanding what you're getting into. When I am at work and I put money in a 401k, I call that speculation because I just throw money at a large cap fund or a blend fund or an international fund. I have no idea who the property manager is. If I'm good, I may look at the Morningstar report and see what that fund is rated, but 9 times out of 10, I don't. I've heard of, I'll just use like Fidelity's low price. I like that one. I've been in it for years. I don't know what it's doing, but it's done well over the years. So I just put money in it every month. Well, that's speculation to me. But I encourage, and especially in a multifamily, these are large investments. Generally, it's starting at a $50,000 investment, unless you're really wealthy. That's a lot of money in anybody's checkbook. So educate yourself. Hang out at meetups, podcasts. Go to one of the national events. Understand the process a little bit so that you're familiar with it. And then make an investment, because only then do you understand the risk and the returns and the rewards. And that's what I think an investor should do. At least that's what I try to do and coach the students that I'm working with on to do. So you understand multifamily. You don't have to understand it all. You certainly have to know, like, and trust the sponsor. You have to understand the submarket and what's the business plan so that you can hold that general partner accountable. And, I still go to conferences. I'm sure you do, Chris, too. And so I'm still learning. I'm still learning 10 years in and hope I never stop.
Yeah. And talking with other folks too, because it's such a small community. And whenever negative vibes start to appear, that it travels fast. So when you hear that, hey, so-and-so, or so this happened or this happened, whatever, it's hard to hear that noise if you're completely 100% passive, meaning you're not going to these conferences, you're not going to the networking events, you're not talking with other operators and other limited partners, you're talking with the vendors. So you kind of have to get a little bit wet, especially in the beginning. But I'd like to have a close ear to the ground with folks that are really in, because that helps me stay in touch with trade winds.
Yeah, and I'm not known by everybody, neither are you, but there's probably some people that do know us. And if you ask 5 people, in one of those networking, ever heard of Randy Langenderfer or Chris Bounds, probably find somebody to know us and give you a thumbs up or a thumbs down. And to that point of it's a small world, and we're all trying to protect our reputations by providing good returns to our investors and keeping those positive testimonies alive. So.
Yeah. But to take it one step further, there's also a lot of folks, now I'm speaking more on the operators, that well-intentions were definitely there, but things happen, and sometimes even the most well-intended operator can make short-term decisions that negatively affect their investors. So that's definitely the minority, but there's a lot of money at stake. The minority could be a $20 million pool of investors. So knowing that might prevent you, and some of them could have a really loud and impressive social branding because everyone's an expert on social media. So knowing that can help you navigate or at least tread a little bit lighter when having those conversations. And I'll say this too. You don't have to believe all the negative. Like that's not all true either. It's just take with caution and proceed.
I'm not as good as some say I am, and I'm not as bad as others say I am, as I always used to say in the corporate world. So yeah, and if you and somebody told me once too, if you do 5 deals, there's going to be one home run. There's going to be 3 right down the middle of the fairway, and probably one of them that's lagging or not where you wanted it to be. And it's true in multifamily too. Not everybody can hit a home run all the time. If you're in the business long enough, you're going to have a fire or some kind of violence on the property, and bad things happen. It's how you manage out of them and how you operate out of them.
100%. That last part's 100% because and it doesn't mean investors may not be upset because they probably will be, but yeah, it's how you deal with it that's going to save your reputation, or worst case, maybe lawsuits. I mean, there have been flips where we've lost money on. Our investors got paid 100%. And we're very transparent with them. There have been flips where, hey, we had a 6-month loan. For some reason, the market took a little bit longer. We called them like, hey, look, what do you want to do? Do you want to refinance? Do you want to extend? How would you like to do that? So as long as you're transparent, most of them, I think nearly all of our investors, our private lenders in those cases were fine extending because they knew my reputation. There were a couple that they just needed their money for other reasons. So we refied them out and all was good. But there was that constant communication.
You hit it. It's the constant communications. A lot of people go radio silence in bad times.
Yeah, that's the worst. That's the worst.
As a limited partner. I mean, I remember one example that comes to mind, just that things weren't performing as well, and the general partner, was getting kind of beat up by myself and other limited partners, and went radio silence for about 6 months, and it ended up having an average return after 3 or 4 years, but it never invested again. And that's just a red flag that potential investors can ask others, hey, how does this group communicate? What's their track record beyond what just the GP is telling? Back to what you said, the word of mouth references are huge in this industry.
Yeah, because we're really, when you get in that situation as an operator, as a general partner, like you're a steward, you've got fiduciary. And at the end of the day, if mistakes happen, whether it was your fault or it's just the market, like you just gotta cowboy up and take the punches, and just keep doing what you can, and in order to get the returns back for your investors. But moving on, so you've this kind of last question, then we'll move on to the closing. You're now full time.
I am.
You're a full time investor now. So, and I think that's a recent development, right?
Yeah. So we're recording this the first week in April, and I just stepped aside at the end of March from my full-time employment here in the Houston Medical Center, where I was administrative type, and had a long and, I would say, prosperous corporate career that I didn't want to change. But I have recently made that full-time transition, and I have to do deals, but I want to do deals, and I've just got the bug, Chris. I'm excited.
So no, just sailing off into the sunset and Mexican beaches. You're enjoying this. You're having fun.
Yes is the short. Yes, and yes. And as long as somebody said, why do you do this? And I think if you ever heard of John Maxwell, I coined his phrase. He's a motivational speaker, and he says, well, what's he say? High energy, low IQ. So as long as I have the high energy, I'm going to continue to do this, and it's just, as my father said a long time ago, if you find something you enjoy doing, you never have to work a day in your life. And I don't consider this work. My corporate job was work toward the tail end, but I don't consider this work. And, chasing down deals, I'm getting off. We get off the phone here, I'm running up to a property and doing an on-site tour, and it's not work. So
yeah. So I think something good to highlight there is you were able to accumulate and invest in over 4,000 units with a full-time job. Probably wasn't easy, and I'm sure that took quite a bit of time at times in your off hours, but you were absolutely able to do that. That is possible. And then now you've been able to step aside, and I mean, you've made the choice to really keep pursuing the real estate ventures and investments.
Yeah, thanks for summarizing that. That's great. I probably should have led with that. But you're absolutely right. This is something that people can do full time, especially as a limited partner. If you're looking to just diversify your portfolio out of stocks and bonds as the traditional investment guy is going to sell you, if you want real estate without any of the headaches that us general partners experience, you're purely along, the illustration of the pilot. The general partner is the pilot up in front of the plane who's worried about the passenger safety and air traffic control and the weather and all those variables, versus the passenger in the back of the plane or the limited partner who's just sipping their favorite beverage and enjoying the ride, reading a book. And so, if you're not the type that wants to be active, this is a great industry for you to find a general partner like, and trust, come alongside of, and make a very handsome return. Make a very handsome return.
And that probably goes into, we were talking early on, like single family versus multifamily. Could you be an operator with a full-time job in multifamily? Maybe, but be ridiculously difficult. Could you be an operator single family with a full-time job? Absolutely. It's easier. And that's how most people start, and that's how you got started. Could you be a limited partner or passive investor in either one of those with a full-time job? Absolutely. That's very easy. So you just got to figure out what do you want to do.
Yeah. And I think the only thing I'd clarify, and I think you'd agree, is it's difficult to grow that single family operations business as a full-time employee.
It is. I do simplify it with folks that if it's just wealth building, if you buy one a year for 10 years, and that's all you did, you're a multimillionaire. You have well over $1 million, depending on your market area, you'd probably $2 or $3 million in assets. You just got to let your tenants pay them down. So you're not going to be able to retire. The passive income is not going to be anything super substantial, or really anything you can count on. But from a wealth building standpoint, it'll get you there. You work your job, you get your 401k, IRA, and all that, and then real estate on the side, you'll be okay. But if you want to do something and really be able to push yourself to retire, it's going to take a different game plan. You're going to have to scale up the single family, more challenging. But if you go the multifamily route, which you did, it's a lot easier to get 4,000 units. I can't even comprehend what 4,000, much less 1,000 or 500 single family units would do to my life.
Oh my, yes. Well, the worst part about a limited partner of 4,000 doors is just K1 time. It's getting all the K1s to prepare my taxes. That's the biggest headache I have as a limited partner, and that's very manageable. So,
yeah. Okay, so let's move on to the closing. I asked these 4 questions to the same to every guest. Starting off with, if you could give advice to your 20-year-old self, what would that be?
Wow, you didn't prep me with these, Chris. It's okay. What would I tell the 20-year-old Randy? I think the advice I would be is to think outside the traditional, go to college, get a good degree, get a good job, climb the corporate ladder as fast as you can, and hope to retire many years later with a livable wage. And that's not bad. I'm not disparaging that. That's what I did. That's what my father did. But I think in this economy, I have adult children, and I always encourage them to develop a side gig of something that's not real estate. It's something else. Be entrepreneurial somehow. So, and if you want to be entrepreneurial, I think you should take a solid look at commercial real estate.
Love it. What book or books have greatly influenced your life?
There's been several. I guess I would say from the personal side, I'm a person of faith. And so I always say the Bible is my favorite book of all time, and one that I spend a lot of time in and try to guide my life after. On the professional side, The Hands-Off Investor by Brian what's his last name? Yep.
Brian Burke.
Yeah, I'm just reaching up to get it. Brian Burke. I think I don't know if that's the most inspirational side, but for your audience and the limited partners, that is a very good book. Goes into a lot of detail for you to get your head around. If you understand that book, you're going to be a great investor.
It's funny you mentioned the Bible on the personal side. I would say that could be considered a Bible from a limited partner side for multifamily. It really lays everything out. I've read it several times, and it's a good basis on how to approach your investment.
It's a good crash course.
Yep.
I like that one.
In the last 5 years, what new belief, behavior, or habit has most improved your life?
I have been working very diligently on addressing consciously my limiting beliefs. So we all have limiting beliefs. I did not think that I could accumulate 1,000 doors as a GP or 4,000 as an LP. I did not think that anybody would ever invest with me. I did not think that I had the savvy to do this, and many more that I have continually worked around and just said that it is doable, and to address those kind of head on has been, I think, the biggest rationale for my growth, to say, what have you got to lose? Try it.
We could have an entire episode on just that. I love that.
Yes, the limiting beliefs that we all possess, whether you're, Rod Khleif or somebody who's a big megastar in this industry, or the little person down below.
Yep. How can people reach out to you?
Well, Chris, I just really want to thank you for being on the show again. It's been a lot of fun and great to get to see you again. The easiest way to contact me is get on my webpage, which is invest-ark, invest-ark.com. There's a contact us page there. Love to chat with any of your listening audience about anything, more specifically about real estate.
Love it. Well, appreciate you coming on the show, and I look forward to connecting with you again soon. Thanks for tuning in. If you got any value out of this at all, please like, comment, subscribe, follow. I'd love to hear from you. And for more real estate related content, market observations, upcoming events, you can go to investedx.com and subscribe to our weekly newsletter. I promise you won't regret it. Thanks again.